All right. Hello again, everybody. Welcome into our midweek options update. My name is Mike Rixey. I am the lead options instructor for NetPicks. And what I'm going to do here over the next few minutes, I'm going to walk you through some of our trading here this week. We've had a very busy start to the week. We've got a very active market again today. So I'll walk you through some of our trades that we've closed out here this week. We'll also take a look at a couple of markets that are catching our eye for potential new setups going into the second half of this week. So if you have any questions at any point in the session today, feel free to type those in. And I'll get to those as soon as I can. If you are watching the recording on Facebook or on YouTube, you can always comment there and I'll get back with you as soon as I can. My email address is mike@netpicks.com. Feel free to reach out anytime. More than willing to talk markets anytime. I love talking markets. I'll talk about markets all day long if you let me. All right, so let me just make sure that my volume is coming through okay. So it looks like we are good to go. All right, so let's start out by talking about the daily chart of SPY. We have had some very crucial levels tested here over the past, really over the past week, but specifically over the past 24 hours. If I zoom into this daily chart of SPY, I've got a variety of different moving averages, a mix of simple and exponential moving averages. And going back to last week, we had this solid pink line. That's the 8-period exponential moving average. And it was tested a couple of times last week. It was tested, but it wasn't broken on a closing basis. And I stress that because a lot of times you see those levels tested intraday. They might even break intraday and you think, yep, here we go. We're going to get a big move out of this pattern. And then we see a reversal into the close. That level held a couple of times. That level last week, let me get my data box up. I'll get you the exact number. But it was held. And what we have seen happen off of that test in the past, we've seen that level tested, hold a support, and then we get another springboard move back to the upside. That level last week was just below 417, right around 416.85. Well, we finally got a gap below that level yesterday, and we did get some selling intraday yesterday. Here's the problem with the session yesterday. Okay, notice that we not only broke the 8-period EMA, but we got down and we tested the green lines there. Those are the 20-period simple moving average and the 20-period exponential moving average. Both of those levels were tested and they held into the close because yesterday afternoon, we rallied up off of the lows. We didn't close up near the highs of the session, but it was a very impressive rally off of the lows. And we can see what's happened again here today. We tried to sell off early in the morning. We found support right on top of these moving averages. Until these levels break on a closing basis, we're going to continue to see these dips bought. I don't like it. I don't like the fact that we just, continue to see all-time highs on a daily, a weekly basis. Really want to see a deeper pullback to work off some of these overbought conditions that we're seeing. Now, on an individual stock basis, we have seen some additional damage done. You take a look at Amazon, you take a look at some of the other tech names after earnings. We have seen some selling pressure on the individual stocks, but on the index products, SPY, QQQ, IWM, we continue to see a rotation between those products. And there's always one area of strength that prevents any type of market-wide weakness from kicking in. And that's why we continue to just see this cycle of new all-time highs on a regular basis. So where does that leave us? Here we are midweek. Where does that leave us going into the end of the week? Well, we know if we look back, it's been a super strong trend in place now for the last few months, but we have seen a lot of rallies going into the end of the week. Okay, a lot of people got short or at least closed out of long trades yesterday, specifically early in the session, because they were expecting that to be the start of the pullback. So now that we're getting a rally back higher, there could potentially be another short covering rally, people looking to initiate more new long setups, and that could lead to another push back up to the all-time high towards the end of the week, right around 420.72. I really don't want to see that happen, and here's why. If we go back into late March into the first part of April, look what happened as we continue to see these new highs hit. We continue to see the market head higher. Look what it did to volume. Volume went from up above 100 million shares to down close to 50 million. we saw the volume contract. We also saw the ATR, the average true range indicator, down at the bottom. We saw it go from up around 6 to down below 4, which is where we're at currently. When we start to see those one-way moves specifically to the upside, the volume contracts, the intraday range contracts. That's not something we want to see as active traders. We want to see the back and forth movement. I want to see the good volume. And in order for that to happen here going forward, we're going to need to see some further selling, whether it be yet this week or even into next week. We'll just have to wait and see. But we still have a lot of overbought conditions, a massive amount of room to the downside on many of these names. We just haven't seen any type of follow through for any length of time. So 420.72 would be an area of resistance should we continue to rally higher into the end of the week. And then the moving averages that we just got done talking about, the 8 EMA, which is currently sitting right around 417. And then we have the 20 period simple and exponential moving averages down below, right between 413.50 and 415. That would be a cluster of support levels that we'd want to watch here over the next couple of days, right? So again, want to see that volume number pop back up. Today's rally has been impressive off of the lows, but we've only had 23 million shares trade so far today. That's pretty light volume. I want to see that volume number pick up. The VIX is down $1.50, back down below 18. It briefly yesterday approached 22. So any type of weakness that we see, it's been this way now for months. Anytime we see that weakness, it'll last for a couple of hours and they immediately come in and suck the volatility out of the market. We're seeing that again here today. Long term, I want to see that VIX back above 20. If that happens, it makes it such an easier environment for us to be active in. All right. So let's take a look. I want to take a look at our overnight pop trade. I know we've got some of our current students joining us here today, some of our current members, and let's talk about the overnight pop trade on SPY. This trade was put on yesterday afternoon as part of our overnight pop trade service, but then also as part of our ETF program. And what we did, we put these trades on the afternoon before expiration day. SPY has Monday, Wednesday, and Friday expiration cycles. We have 3 different expiration cycles to take advantage of each week. So coming in yesterday afternoon, we typically like to put these trades on between 3:30 and 3:45 p.m. Eastern time. That's a very common time for us to place our trades. So we came in yesterday afternoon. We had seen that bounce off of the lows. We were expecting another push to the downside, but we just obviously have not gotten it. We came in and we sold the 416, 418 call spread on the options that expire here this afternoon. So we sold the 416 call. We bought the 418 call at the same time. We put the trade on for around 52 cents. We collected $52 per spread on the trade yesterday. It tied up $148 of our capital. Some of you were able to get better fill prices. Those of you that waited towards the end of the session, I think I saw 65 cents or so was the highest price that I saw from our members getting filled. But we got filled at 52 cents. So that's the number that we're using to track this setup. Well, it's currently trading for $1.36. We sent out a closing alert this morning. We briefly, let me pull up a chart here, an intraday chart, and you can see it. We briefly had a move to the downside in that first half hour of the session. Try to zoom in here. It was this little push from the downside right after the opening bell. Actually, it lasted about 60 minutes. The first hour of the session, we did get a move to the downside. And we sent out a closing alert right here, right around 10:20 Eastern time. And at that time, the trade could have been closed out for a partial profit. Here's the problem. I sent out the alert, and within a few minutes, price action had reversed right back to the upside. And we've basically, since 10:30 Eastern time, the last hour and a half, we basically moved straight higher. I did not get filled. Okay. I haven't heard from anybody that did get filled. Unfortunately, the market just reversed too quickly and it never got back down to the price that we were looking to close it out at. Had we gotten filled on that closing order, it would have been a very small profit, which would have been a huge victory considering that the trade was definitely underwater right at the open. Unfortunately, we were not able to get filled. So I still have the trade on. So what do? Let's talk through the different options that we have. This is a neutral to bearish position. I want price below 416. That's the way I make money on the trade. Right now, we're currently sitting at 417.5. In order for that trade to battle back, we would need $1.50 sell-off between now and the closing bell this afternoon. Now, we just haven't seen any signs of weakness over the past hour, hour and a half. So yeah, it's a little tricky to hold. So our options are, if you wanted to hold, you could. It is a risk-defined trade. The most I can lose on the trade would be $148 per spread. If you're comfortable taking the additional risk, you could hold into this afternoon looking for a pullback. The other option would be to close out of the trade now and take a partial loss. When I open these trades, the goal is to close them out the morning of expiration day, typically in the first 60 to 90 minutes of the session. There are times that, like today, for example, that we end up holding into lunch. I don't typically like to hold these trades into the afternoon because I don't want to have to sit there and babysit them all afternoon. I really want to close them out as soon as I can. So I'm going to be looking to close this trade out here over the next half hour or so. Normally, when I get into the lunchtime hour, I like to give it to lunch because it allows us to see what happens after the European markets close. Do we get a 12 o'clock reversal? And then as we get into 12:30, 1 o'clock, that's typically when I would take a look at closing out of the trade, either for a partial profit or a partial loss. In this case, if we close the trade out now, it is going to be a loss. If we get filled at $1.30 here, let's just say we close it out, we buy the spread back for $1.30. That is going to leave me with about an $80 loss per spread. Okay, so obviously we didn't get the move to the downside. Actually, we got it this morning, but it didn't last very long. And that bounce that we have seen over the past 60 to 90 minutes has certainly turned this trade around, unfortunately, for us. So I'm going to most likely take a loss on the trade over the next 30 minutes unless something crazy happens between now and then. And then we just move on. Our next opportunity for an overnight pop trade would come Thursday afternoon, tomorrow afternoon for Friday expiration. That is a really good sweet spot for us because not only can we trade SPY Thursday afternoon, but any stock or ETF that has weekly options, we can take a look at that overnight pop trade. So Thursday afternoon is a very busy afternoon for us, and we'll take a look at getting another trade or two on at that point. And Kevin stating, good afternoon. You're from Lakeland, Florida. Well, hello, Kevin. Hopefully it's better weather for you there than what I'm experiencing here in Indianapolis. We have a sunny day here in Indianapolis, but it's cold. It's May and it feels like March, unfortunately. All right, so any questions on the overnight pop trade, feel free to type those in. Again, the plan here is to close it out over the next 30 minutes or so and take the loss on the trade. All right, so let's talk through, not going to have time to go through all of them, but some of you that are existing members, you know that yesterday was a very active session for us. We closed out of a number of winning trades, specifically early in the day when we had the markets down near the lows. We were able to close out of numerous winning trades for us. And I wanted to cover a couple of them, and then I'll get to the new trades here. But I just want to talk about these briefly because I've had some questions on why we ended up closing out of the positions. So let's talk through, and I'm trying to pull up my spreadsheet here. Let's talk about a simplified options superstars trade first. And the one I'm trying to pull up is the trade on Snapchat. So this was a trade that we had put on back on Monday afternoon is when we put the position on. We came in and we bought the June 55 puts. Okay, it was this option right here. We came in and we bought that option for $2.63, $263 per contract. It was a bearish position. We were looking for a move to the downside, and we got that. So we put the trade on Monday afternoon. We ended up getting the move lower here yesterday, first part of the session. And we ended up closing out of the trade yesterday for $4.65. It gave us a $202 profit per contract. It was a 77% return on our capital, in and out in less than 24 hours. I wish I could tell you every trade was going to do that. It was an outlier type move, just a very quick move. The timing was perfect on that trade. All right, so why did I close it out? I had some questions come in. These options have 44 days left to expiration. If this market is still overbought, if we're still looking for a move to the downside, why not hold and see if we get a bigger move lower? The problem with holding today is a perfect example. If you take a look back over the past few months, anytime that we've had selling, it lasts for a couple hours at a time, maybe a day or so, and then the dip is bought and we head right back to the upside. If I can come in and book a 77% return in less than 24 hours, I'm going to take advantage of that until the market starts to open up a bit on the downside. These downside moves have not lasted long. They just really have not given us the opportunity for those runners, for those extended moves that go on for days or even a few weeks at a time. So you've got to be quick on the downside. That'll change. We'll certainly see some deeper pullbacks in the months to come. But until price action confirms, I'm going to try to take profits quickly on the downside. Had we held, it would still be a profitable trade, but it's trading about 80 cents or so below where we closed out of the trade yesterday. So still profitable, but we would have a smaller profit at this point had we held. And who knows? I mean, maybe over the next week or so, the bottom falls out, a snap again, and it ends up turning into a home run trade. But definitely happy with the 77% return and ended up closing out of the trade. So we're going to do our best to take what the market's given us. Obviously, I would love to have the 150, 200% returns, but the market's not always going to make that available to us. So we've got to take what the market's given us. And at this point, we're going to go ahead and look for the smaller returns. And 77% return overnight, I mean, we'll take that every time, right? Let's talk about a credit spread that we closed out. And let's talk about Google. This is a trade that we had put on back on April 28th. So Google had released its earnings. It had just a phenomenal run into earnings and then after earnings, and the market got very overbought. So we came in and we sold back on the 28th of April. We came into the May monthly options and we sold the 2440, 2445 call spread. So let me go ahead and load that up. I have to open up some additional strikes here. And I've got to go out to the 2440 call, right click on that call, go to sell and select vertical. And that pops up in order down at the bottom where I am selling the 2440 call and buying the 2445 call at the same time. We put this trade on and we collected $1.66 or $166 per spread. Now, some of you might be intimidated by trading Google because it's expensive. It's a $2,300 stock, right? You buy a long call or long put, you're talking about thousands of dollars per contract. Well, by selling the call spread, it gave us a neutral to bearish position. Here's the best part. It only tied up $334 of our capital. That was the most I had at risk on the trade. That was the most I could have lost on the trade had the move gone against us. Selling a call spread is a neutral to bearish position. So I was looking for either a period of consolidation or a reversal lower. Well, over the past week, we have seen weakness in the NASDAQ names, and we were able to close out of this trade yesterday for 55 cents. It's currently trading right around that level, around 60 cents here at the moment. So we ended up closing the trade out. We booked a $111 profit per spread. That was a 33% return on our capital, and we're in and out in about a week, right? So the reason I love this trade is it allowed me to stay active on a high flyer like Google with a few $100s of capital. It gave me 5 ways of making money on the position. I made money if the stock moved up, down, or sideways. As long as it stayed below 2440, I got to make money. I made money from time decay adding up and from volatility decreasing. So I had 5 different routes to follow in order to make money. We got the move lower. That allowed us to make money the fastest. Had we just chopped sideways, if we didn't get a big move to the downside, I still would have been able to make money. I just would have had to hold the trade longer. Thankfully for us, we got the move to the downside and we ended up closing out of the trade yesterday. So why not hold? If we still think the market's overbought, why not hold for a bigger move to the downside? Like we just talked about on Snap, we just have had very little follow through, especially in the tech sector. Those tech names have not liked to stay lower for very long at all. So to book a partial profit, book a 33% return on my capital in a week's time with a trade that had 5 different ways of making money, that's exactly what I'm looking for. I'm going to go ahead and close out of that trade, free up the capital, and move on to the next position. I do not like to hold trades all the way up to expiration. So the credit spreads, we're typically targeting between 20 and 40% returns on our capital is very typical for us. So this fell right inside of that range, and we ended up closing out of the trade. I won't go through all of the ones that we closed out of yesterday. We closed out of winners on Autodesk, Lulu, AMD, EEM, QQQ. A lot of them had very similar chart patterns. A lot of them had neutral to bearish trades on. We sold out of the money call spreads, and we took advantage of the move lower to close all of those trades out. Returns on those trades ranged from 20 to 35% or so. That was the range that we saw on the return. So it was a very profitable day yesterday, closing out of those open positions. Unfortunately, we gave a little bit back here with that partial loss on the overnight pop trade that we talked about a few moments ago. So let's talk about some newer trades. I know there's some of you that are joining us for the first time today. A big welcome to you guys. So what I've done so far is just talk through trades that we had on. We have some existing members that are joining us here today. So I wanted to talk through why we made those decisions here over the past couple of days. But now let's talk through some new potential setups, trades that are actually presenting new opportunities for the next couple of days. Let's start out with a chart of SPY. We talked about SPY earlier, but that was on the daily time frame. We're now going to narrow it down to the 195-minute chart. The two chart timeframes that I like to use personally are the 195-minute and the 130-minute. Those are the two that I have found work really well, identifying setups for us without getting caught up in choppy conditions. Sorry, guys, I'm going to grab a quick drink. Dealing with some allergy issues here this week, so I can kind of feel my voice going, and I want to take a drink before that happens. All right, so looking at SPY, you can see the selling pressure from earlier in the week. Okay, we actually saw price action break below our red and blue line up at the top. All that simply is an 8-period exponential moving average. So we saw price action break below that level. What we couldn't see happen yesterday is price did not break below the yellow line, which is the 50-period exponential moving average. So price action, obviously you can see we're rallying back higher today, and we're actually trying to recover above the AEMA. So we're going to want to watch that closely here this afternoon. So what happens for new trade opportunities for us over the next week or so? If our trend strength histogram down at the bottom, it just went from blue to red yesterday. So on the open, the first half of the day yesterday, we started to see bearish momentum take over. Once that indicator goes red, that does give me the opportunity for a new bearish trade. That's what those two blue plus signs represent on my chart. So unfortunately, price action never got down to that entry point. I say unfortunately because I want to be active, but fortunately for us, it's kept us out of the bounce so far today. So that trade for the moment is still valid on the downside. However, this afternoon and into tomorrow, if we see this rally continue and that trend strength histogram goes from red to blue again, we would no longer be in a bearish outlook. We'd be back to bullish. Really don't want that to happen, but it's something that we have to watch closely. So in order for me to get bearish here, I do need to see price action confirm back to the downside. Twitter. So my portfolio long-term, I want to be mixed. I want to have a good mix of bullish and bearish trades on. Up until yesterday, my portfolio was certainly leaning more towards the bearish side. I had a lot of call credit spreads on. I had some long puts on. I lightened up on those positions yesterday. We closed out of numerous positions yesterday, but it still leaves me with a handful of bearish positions on. So I'm still okay there. I would be looking for some additional new bearish trades as long as price action confirms to the downside over the next couple of days. But where I'm light in some areas is I don't have very many bullish leaning trades on. And that makes sense. I mean, this market has been super strong, right? I mean, trying to chase these all-time highs, not something that I'm looking to do. Initiating new long trades here with new long call options, I think it's a very difficult game because the market is still very extended on the upside. So I want to have some bullish exposure on, but I'm going to do so with a safer strategy. I'm going to try to take a look at some of the more oversold names on the board. We've had some of these stocks get hit after earnings. Twitter's one of them. I think it's working on 8 days in a row to the downside. It's oversold. So I'm looking for some potential credit spread opportunities, specifically selling an out of the money put spread. Now, why am I drawn to Twitter? It's the same 195-minute chart that we were using over on SPY, but now the indicator that I'm looking at is the pulse indicator down at the bottom. It's that yellow and green histogram. The past 5 bars there have plotted green. What that indicates is price is between a 2 and a 3 standard deviation move on the downside. we're oversold. Less than 2% of all occurrences fall outside of this range on the downside. When you see this pattern develop, it'll typically lead towards either a period of consolidation or a reversal, in this case, to the upside, a bounce to the upside. Look what has happened since we saw the yellow and green bars start to plot here late last week. See how price action has started to stabilize down here? We're starting to see a little bit of a rounded bottom there start to develop for us. That's a very typical pattern because price has hit an extreme. It doesn't mean we can't head lower. It just means it's not statistically probable. Odds favor either a period of consolidation or a bounce to the upside. So what I'm looking at is the potential to sell an out-of-the-money put spread. And we actually put this trade on yesterday afternoon, but it's still valid today. So I'm going to walk you through the details of what we did. So this is going to be a neutral to bullish trade looking for a bounce to the upside over the next couple of weeks. And for this trade, we went out to the June monthly options. Those are the ones with 44 days left to expiration. I'm going to go ahead and open those up. I'm going to go to the put options on the right-hand side, and we're going to go to the 50 strike. Notice how that 50 strike, it does have good volume. It does have good open interest. I want to trade very liquid products. When I talk about liquidity, I'm talking about volume and open interest being in the hundreds or even thousands of contracts. The bigger the liquidity, the easier it's going to be for us to get in and out of trades quickly and at good pricing. All right. So I right-clicked on the 50 put. I went down to sell and I selected vertical. And that pops up an order down at the bottom where by default, it has me selling the 50 put and buying the 49 put at the same time. What we did is we changed the 49 put to 48. Okay, so now it has me selling the 50 put, buying the 48 put at the same time. We got filled on this trade yesterday around 52 cents, about 3 cents higher than what the current price is at. So let's go ahead and change that price to 52 cents so I can show you the exact details of the trade that we put on yesterday. And then we hit confirm and send. So this trade makes money 5 different ways. I make money if the stock moves up, down, or sideways, as long as price stays above 49.48. That's my break-even point here in my order confirmation box. The current price of the stock's at 54.24. We've got almost $5 of cushion here where this trade could move dead against us, and we're still able to make money. Now, we're not expecting a big move lower because we just talked about the stock being oversold. We're expecting that sideways move or move to the upside. The only move that hurts me is a big move below 49.48. Any type of a move above that level, and I'm okay. Okay. Now, we also make money from time decay adding up and from volatility decreasing. So every day that passes, that helps us. The options will lose value. That's going to help us. And we make money if volatility decreases. So now, if we get a big move to the upside, that's great. If we don't get the big move higher, we're still okay there too. We can still work with any type of a sideways move. A small move to the downside is okay. The only directional move that hurts us is a big move lower. So it's a very forgiving trade. And if we're dead wrong, we're out $148 per spread. That's the amount of capital required to put this trade on. That is also the most I can lose on the position. Notice my risk reward ratio here. I'm risking around 3 to make 1. Some people get concerned with that. The reason I am okay with that ratio is because we do have those 5 ways of making money. This trade is going to have a much higher probability of success long term. Okay. And bear with me here a second, guys. At the corner of my eye, I see the market moving lower. So I've got to adjust an order here in a moment. Okay. So I'm okay risking between 2 and 3 to make 1. Those numbers will work for me long term. If I start to risk 4, 5, or 6 to make 1, I just can't make those numbers work. Okay, so we've got to pay attention to that risk reward ratio. We've got to keep it. We've got to keep it at a decent level, and for us, that means risking between 2 and 3 to make 1. All right. So that is a neutral to a bullish trade on Twitter. We make money if the stock starts to stabilize here and starts to bounce higher. All right, let's go back over to the charts. Let's take a look. Let's take a look at UUP. This is the dollar ETF, the bullish dollar ETF. And we've got a potential trade setting up here. Okay, now the dollar has certainly been beat down, right? Everybody knows that. I mean, we have certainly seen movement in the dollar, but we've started to see a little bit of a bounce here over the past week or so. Now, I'm not going to talk about the fundamental reasons why. We could sit here for the next hour and talk about the different fundamental reasons to trade the dollar in both directions, really. What I'm looking at is from a technical perspective. What is price action telling me? Because it's my opinion that all of the fundamental news, all of the headlines, all of that is going to be baked into the price of the stock or ETF. The technicals are going to tell us everything that we need to know, right? So what am I seeing here? Well, we have seen price action bounce over the past week. We have seen price action close above the 8 EMA, which is the red and blue line. We haven't seen it break through the white line. That's the 50 EMA. I still would like that to happen over the next week or so. But we also have seen our trend strength histogram down at the bottom go from red to blue. It has flipped from bearish momentum to bullish momentum taking over. That's why you're seeing the 3 blue plus signs. Let me go ahead and zoom in so you can see those in more detail. That is actually indicating a valid long entry point for me. And it's currently sitting at 2460. It hasn't hit yet. I'm not going to put the position on yet because I need to see that entry point hit first. But it is, for the moment, a valid long entry point. If that entry point is hit, how would I go ahead and put on the position? Could I use a credit spread? Sure. We just talked about that over on Twitter. But I want to mix it up. I want to take a look at strictly buying a long call. Now, go ahead and pull it up here. If you look at that and say, Mike, why in the world would I want to buy the dollar here? Keep in mind, I am not looking at what's going to happen to the dollar months from now. I'm taking a look at what's going to happen over the next 3 to 15 days. We have seen a decent move to the downside. We're oversold. We've seen price action start to stabilize. We could very well see a bounce higher here over the next, well, we'll see over the next week or so. If we hit that entry point, I'm going to go out into the June options with 44 days left, and I'm going to take a look. We're going to take a look at either the 23 or 24 calls. Okay, now why would I go to the 23 calls? I like to go in the money whenever possible. The reason I'm looking at the 24 calls instead is look at the difference in liquidity. The 24 calls have 7,600 contracts of open interest, while the 23 calls only have 1,700. There's more activity in the 24 calls. The volume numbers, 30 of the 24 calls have traded today. None of the 23 calls have. So there's better liquidity in the 24 calls. The nice part about this trade is those options are trading for 60 cents. Just over $60 per contract to put the position on. So it's a cheap way to put on a directional trade on the dollar. Okay, so that is the potential long setup that I'm looking at for the next couple days. And we need to see one more push to the upside before we go ahead and jump in to that position. So if we put the trade on, what I like to do is target 100% return on my long call options. I like to, if you want to use a defined stop, I know a lot of you do, which is fine. You would use a 50% stop. I'd be willing to risk 50% of the cost of the option. Okay. So you'd be risking around $30 to make 60. So the long calls and long puts are certainly going to have a better risk reward ratio when compared to the credit spreads. They're more aggressive. They only have one way of making money. So it's a lower probability trade. So the long calls, long puts would be a lower probability of success, higher potential return. The credit spreads are going to be a higher probability of success with a lower potential return. So there's trade-offs with both. Again, I've talked about this a lot here the last few weeks. I'm not trying to push you into one camp or the other. Okay, I don't care long term. It really doesn't matter to me what strategy you use as long as you're using a mix. What I don't want you to do is only buy long calls and long puts. If you're doing that, if you're one of those traders that are just buying long calls and long puts, I think it's a huge mistake. If you never consider adding the vertical spreads to the mix, I think you're missing out on a huge opportunity. So the same goes for credit spread traders. Okay, I love the credit spreads. I use them all the time, but it's not the perfect strategy. I don't want you to use credit spreads exclusively either. Having a mix of trades will give you the best of both worlds. Options are the most flexible products in the financial space. What you don't want to do is back yourself into a corner and limit what you can do. You want to take advantage of that full flexibility, and you can do that by mixing up your strategies. A lot of times people, say, hey, I'm going to just buy long calls, long puts, because that's what I understand and that's what I think is the safest. It's actually the most aggressive route you can take. It takes the most amount of risk because you only have one way of making money on the trade. The credit spreads, on the other hand, are much safer trades. They're fully risk-defined trades. And what you're going to find is you're able to drastically reduce the amount of capital required to take those trades. So that's personally why I like to use a mix of both. Long-term, my split in my own personal trading, I would say I'm probably 80% vertical spreads and 20% long calls, long puts. That's typically the ratio that I'm looking at personally, and that's worked out really, really well for me. And Pascal joining us from Belgium. Welcome, Pascal. Thank you for taking time to join us today. And if you guys have any questions on any stocks that you'd like me to take a look at, any stocks that are on your radar, feel free to type those in. I can certainly take a look as we go here. All right, so Twitter and UUP are trades that are potentially setting up for us. I've had some questions on the home builders. I've had some question on the lumber market as well. As crazy as that sounds, right? Who would have thought that we'd be talking as active options traders about the lumber market and the home builders? But that is the world we live in, thanks to the pandemic. Things that we never thought would happen are just the daily norm right now. And we've seen absolute crazy action in the commodities here of late. And lumber futures have been limit up here of late. They are just sky high. We just got done building a home. And what's amazing, we started building our home in November last year. If we were to sign that contract today instead of back in November, the cost of the same model that we just got done building, the starting point for that model is over $40,000 higher than what we signed for back in November. It's just amazing what's happening. A lot of that is due to lumber, but just every cost that you can imagine is gone higher. But yet the Fed says we have no inflation. Topic for another day, right? All that to say, you take a look at some of these home builder areas and some of the individual builders. There are different ways that we can take advantage of these extreme moves. XHB is the home builder ETF. Now, full transparency, XHB has not been a product that's been on my radar over the years. It hasn't been one that I've gone to. Historically, it has not had a track record of big movement back and forth, nor has it been an ultra liquid product in the past. But because we're at such a strong extreme, I've had questions from people asking, how can we take advantage of the extreme movement? XHB is certainly a product that you could add for the next couple of months to take advantage of the extremes. Now, if you were going to do that, how would you do it? Well, we can take a look. Price action just in a super strong uptrend. No doubt about it. Would I initiate a new long trade here on XHB? No, I would not. I would not chase. Not opposed to being bullish, but I would want to see a pullback first off of these levels. Just been relentless on the upside. So on the bullish side, nothing to do as far as initiating new trades. So I want to pull back first. If I do get a pullback, what would interest me on the short side? Well, first, the first point of reference, I need to see the 8 EMA, that red and blue line. I would need to see that level broken on the downside first. That's the bare minimum that I would need to have happen in order for me to put on a bearish trade. So I'm going to keep it on my radar. We tested that 8 EMA at the lows today. No surprise, that level held. We've already talked about that a couple of times. It's a very powerful level. It has held and bounced back to the upside. So if that level breaks, we'll revisit this one on Friday. For those of you that are joining us today for the first time, we are also live on Fridays before the weekend. So we'll take a closer look at this on Friday, see if there's an opportunity at that point for a new setup there. Toll Brothers, symbol TOL, one of the builders. Yeah, TradeStation. Oh, there we go. Just slow to load up the data here. So Toll Brothers is one of the builders. Again, not a product that I have traded all that often, right? But you start to see these extreme moves. This could potentially be a way to take advantage of some of these extreme moves in the commodities, specifically in the lumber market. you have copper, you have some, you have corn, soybeans, wheat. I mean, all the commodities have just been in phenomenal moves here. So we're very overbought. Same goes for toll. I'm not interested in initiating new long trades here at this point because you're chasing all-time highs. What I would rather do is wait for a pullback. In order for me to be interested on the downside, I would need to see the 8 EMA broken. That's that red and blue line. I would need to see that level broken on a closing basis. If that happens, we could potentially take a look at initiating a new short position. If that level holds, if we come back, sell off for a couple days, see those support levels tested and they hold, that could potentially open things back up on the upside. But until that happens, I'm not going to chase here on the upside. So kind of a long-winded explanation there, but I've had numerous questions on the builders, the home builders. Those are a couple of markets that I would consider trading. I don't think they have opportunities as of yet. There's no trades that are, triggering in here at this point. So we'll revisit these again on Friday, take a look and see if there's anything new for us to do. Apple. Everybody loves to trade Apple, right? Myself included, one of my favorite products to trade on a regular basis because it does have a good track record of a movement back and forth. It also is a very liquid product, very good volume and open interest, not only in the monthly options, but also in the weekly options as well. So just a lot that we can do with this one. So let's take a look here. We've had earnings out recently. We had earnings out last week. And a lot of the tech stocks sold off after the earnings numbers came out. And I had a lot of questions come in over the past week on that topic. I mean, these stocks, the numbers on Apple, the numbers on Amazon, I mean, they were good numbers. They were good earnings. And yet the stock sold off. So what gives? When we take a look at what happened leading into earnings, I mean, you go back just to the end of March, and Apple went from down around 118 all the way up to what? 137? It had already priced in a heck of a lot of good news. It was a buy the rumor, sell the news type of event. Everybody was bullish leading up into earnings. All that good news was priced in. And once the earnings came out, there was no longer a catalyst there at that point to drive the market higher. We were already overbought. It was a profit-taking event, and we've seen some decent movement to the downside. So where does that leave us? Well, our system gave us a short setup back on the 30th. Okay, entry point down at 131.19. That trade has moved nicely to the downside. Okay, it's moved all the way down to at the low yesterday, down around 126. It has since bounced. So what do we do now at this point? Do I initiate a new short position now? Do I come in and buy long puts? I would not at this point because the trade already moved too far past the entry point. So if I were to take a look at Apple and say, okay, I really want to get a trade on today, what would I do? Well, look what's happened on the pulse indicator down at the bottom. On that move to the downside yesterday, it didn't last very long, but it was enough to give us 2 yellow bars on the pulse indicator, indicating prices between a 1 and a 2 standard deviation move on the downside. We are in the early stages of getting to an oversold condition in the near term. That has me potentially looking for a credit spread opportunity from selling an out of the money put spread, just like we talked about over on Twitter. Now, would I go ahead and put the trade on now? Ideally, what I like to see on the pulse indicator is I want to see at least 3 out of the past 5 bars plot yellow. Right now, we have 2 out of the past 3. If I can get 1 more yellow bar on the downside over the next couple of days, that would have me interested in putting on a neutral to bullish position, potentially selling an out of the money put spread. So for that to happen, I need 1 more wave to the downside here yet this week. If that happens, we could certainly revisit this one on Friday and see if we can get a new trade on. So there's nothing new that I'm going to jump into right now, but the potential is there for later in the week. Robert asking about Nvidia. Can we take a look at Nvidia? Yes, we sure can. Let's go ahead and type that one in. And again, guys, on Nvidia, on a lot of the stocks that we like to trade, so a lot of you are going to ask for opinions on what we think these stocks are going to do. Keep in mind that my outlook, I'm looking for what's going to happen over the next 3 to 30 days of what we classify as swing trade. So based on what I'm seeing, this is not going to be my prediction on what's going to happen 6 months from now. I have no idea what's going to happen 6 months from now. None of us do. But we can, based on recent price action, get a clue as to what's going to happen in the near term. So on Nvidia, on the 195-minute chart, it's a very similar pattern to what we just been talking about on Apple. We had a short setup that triggered in on back last week, triggered in at 604.49. It was this blue plus sign right there. That printed because our trend strength histogram down at the bottom went from blue to red. So the bearish momentum was taking over at that point. We triggered in, saw a really nice push lower from that entry point at 604.49. That low yesterday was down at 560. That's a really nice push to the downside, right? Very tradable move. Depending on the option that you put on for that trade, you are closing that trade out for a really nice profit. We like to talk about, looking for 100% returns on our long options. Pretty good opportunity, depending on the option that you chose, to take the profit yesterday. So now fast forward 24 hours. We know what the market has done. So now what do we do at this point? If I'm looking for a brand new setup on Nvidia, what do I do? Well, am I looking for a long put position? No, I'm not, because the system already got short last week. You'd be chasing at this point based on our criteria. But just like Apple, we have had 2 out of the past 3 bars plot yellow on our pulse histogram, on our pulse indicator. That indicates price being between a 1 and a 2 standard deviation move on the downside. We're oversold in the near term. If I can get one more yellow bar here over the next couple of days, that would have me interested in a short put spread, a neutral to bullish trade, looking for some of these tech stocks to bounce. We know they have not liked to stay lower very long, right? I mean, over the past number of months, anytime that we've had weakness, the dip has been bought immediately. Are we going to get another one of those situations? We'll wait and see. So I need one more yellow bar in order to sell an out of the money put spread on Nvidia. So directionally for a long call or long put, I'm in a holding pattern on Nvidia. For a credit spread opportunity, I see the potential there for a short put spread over the next few days. So hopefully that helps you out, Robert, in what I'm looking for there. Paul and Lisa, I'd love to hear what you see in COF. Let me go ahead and pull that one up as well. So Capital One Financial. Let me just wait for TradeStation to load up that data. So if you take a look at any of the financial names, right, a lot of areas of this market have been in phenomenal bullish trends. The financials have certainly been they've been strong, no doubt about it, right? I mean, they've been one of the big market leaders, in fact, of late. And a lot of that, if we do, at some point, interest rates are going to have to start, they're going to have to start to go up, right? We know that. You start to see some of these inflation numbers, and at some point, the Fed is going to have to raise rates. I'm not saying they're going to explode, but at some point in the near future, I think they're going to have to start tapering a little bit before this inflation situation gets out of hand. So the financials, obviously, they like the higher interest rates. A lot of that good news has already been baked in, right? We just talked about it over on Apple and some of the tech stocks. Why did they sell off after earnings? Because a lot of the good news was already being priced in leading up into earnings. Well, you start to take a look at these financials. There's been a heck of a lot of good news already priced in. I'm not saying these stocks can't head higher. They certainly can. But we're at points now where this bullish trade, the last bullish entry point that we had was back on April 23rd. Okay, our trend strength histogram went from red to blue. So we triggered long, the system triggered long back on the 23rd. Since then, it's been steadily moving higher. If you're in a bullish trade, I wouldn't have a problem holding it. Would I initiate a new bullish trade here now? I would not, because if you're going to buy a long call, for example, you're chasing at this point. I would be, if I'm in a long position, if I'm bullish, I'm probably taking a look at, potential areas to book some profit. Right now, if you're in a bullish trade, what you could do is tuck a stop right below the 8 EMA, that blue line. Notice how that level was tested yesterday, that level held, and we bounced right back off of it. So, continue to move a stop up just below that 8 EMA. Right now, that 8 EMA is at 149, right around 150. So maybe you tuck your stop around 149.50. Still give it some room to maneuver on the upside, while at the same time locking in some profit as we go. If you are not in a setup, notice our pulse indicator down at the bottom is yellow. In fact, we've been yellow now for about the last 8 bars. This gives us the opportunity to sell an out of the money call spread. Okay, so that I'm not saying you have to do it today. You could certainly wait for price action to come down and break the 8 EMA before you do so. But I would be looking at a cautiously bearish position. I know that goes against the prevailing trend, but we're at a level now where we're so overbought. I think it's going to be more difficult to maintain this pace on the upside. Odds actually favor a period of consolidation here in the near future, or even a reversal to the downside. So this is another one. We can revisit it on Friday. I think it was Paul asking about COS. So yeah, we can certainly ask, or if you're able to join us on Friday, ask me again on Friday, and we'll see if there's another opportunity on Friday for an entry point. I'm not seeing anything that would say, hey, let's jump into a new setup right now, but the potential is there for the next couple of days. David, can I take a look at Baba? Yeah, you're going to see a lot of similar looking chart patterns in the tech sector, but Baba has been doing its own thing here of late. Let me actually zoom out a little bit. So if we go back into February and early March, we did see this move to the downside in Alibaba. Since then, we've kind of been stuck inside of a sideways channel. You know, it's a pretty decent sized channel. I mean, the channel is between 220 and around 245. Price action has just been bouncing around inside of that channel. We are now approaching the lower end of that channel. Okay, so what do? Well, we know that Baba, if we look back historically, we know that Baba is not a stock that likes to stay quiet for very long. None of the tech stocks do. When they start to get choppy like this, and it's been an extended stretch of chop, it's what we call the coiled spring pattern. Price action starts to get tighter and tighter as it stays quiet. It's building energy. At some point, that energy, the coiled spring, it's going to pop. That spring continues to get tighter and tighter. And once it pops, it's going to give us a decent sized move. We just don't know when that's going to happen, nor do we know in which direction it's going to happen in. Based on current price action, well, we are bearish. The setup triggered in back towards the end of April on April 30. It was back at 231.19. So it's in a small profit so far. What I'd want to see happen at this point is I want to see price action get down and actually break through the lower end of that channel down at 220. Okay, so that's another $8 move to the downsides. Yeah, you got your work cut out for you. But at this point, given current price action, I think you've got to lean bearish at this point. And we'll see if the overall market wants to give it up a little bit. That would certainly help. Would I initiate a new position here today at this very moment in time? I would not. If you want to put on a bearish position, at least following our criteria, I'd want to see a bounce closer, a bounce back up to around 231. If that level is hit, at that point, I'd be interested in initiating a bearish position, looking for that move back to the downside. So cautiously bearish there on Baba. Definitely been one of the weaker names out of the tech sector. David, can I also explain scaling in and out? So there's a lot of different thoughts on this, David. You know, scaling in and out of positions, it can be powerful as long as it's done correctly. And what I mean there is when you scale into a position, let's say you're normally looking to trade 10 contracts. Instead of putting on all 10 contracts all at once, let's use this Baba example. Let's say back last week when that setup triggered in, right here at 231.19. Let's say you put on 5 contracts there and said, I'm looking to add 5 more contracts, but I want to wait first. And maybe you want to wait to see what price action does over the next few days. So let's say if price action gets back up and tests 231 over the next couple of days, maybe at that point, you put on the second half of your trade. Okay. Some people would put on the first part of the trade right there. And then as price action bounced higher, they would scale into the second half of the position up at a higher price. So you're getting a better average price on the overall position. And then scaling out as price action starts to move lower, instead of closing out of the entire position all at once, maybe you close out of half of the position or 25% of your position. And you start to scale out of the trade, booking some profit as you go. I like the idea of scaling out of a trade. If you're used to trading multiple contracts or multiple spreads, scaling out can be a great thing because you're booking profit along the way, reducing your overall risk along the way. I like that. Where it starts to become an issue is when you start to double down. Meaning, let's say you put this trade on. Let's say you put it on last week, and instead of moving in our favor to the downside, price action moved higher. So you put on the first part of your trade at 231, and then all of a sudden price action's all the way up at 236. And you decide to add another position there. Yes, you are getting a better average price on the trade at that point. But where most people get into trouble is they add a full position at 231. They put on a full 10 contracts there, and then they put on a second round of 10 contracts when the trade's moving against them. They're doubling down. They're trying to average in. And the problem there is you start to get into a position that has way too much risk. Over time, we're going to absolutely have losing trades. It's part of trading. It's going to happen regardless of the market you're trading, regardless of the system that you're using. So what you want to be cautious of is getting frustrated, letting that emotion take over and saying, hey, I'm determined to get this thing back to a winner. If I continue to add to my position, I'm able to recover much faster. I'm not opposed to adding to a losing position at times, as long as you continue to manage your risk along the way. Never get into a scenario where you've got 30, 40% of your account tied up in one trade. It can get painful in a hurry in that type of a situation if the trade never recovers for you. So if you're going to plan, if you want to start to get into a routine of scaling in and out of positions, take that into account when you put on your initial position. So again, if you're used to trading 10 contracts, only put on 5 initially with the plan of scaling into another 5 a few days later. That way you're still in a normal risk position. You're not taking on any additional risk, and you just have a little bit more flexibility with how you manage the trade. Doubling down, I've heard horror stories of adding to losing positions. It can get painful in a hurry, no doubt about it, if you let that position size get away from you. Okay, Paul and Lisa. So I got to your question, and David. Hopefully, I got to your question and got you the answer that you were looking for. So I'm just trying to take a look and see if I missed any. Snap, please. Yeah, we talked about Snap here earlier. Snap was a trade that we put on Monday afternoon with our Simplified Options Superstars program. So we came in, I mean, looking at this chart at the 195 minute, this was the trade from back Monday afternoon. We saw our trend strength histogram go from blue to red. So we saw the bearish momentum take over, and we put that trade on the very next day. I mean, yesterday morning, we had the tech sector, we had the whole NASDAQ index getting beat up. So it wasn't, well, I mean, was this a record-breaking move to the downside? It wasn't. But we ended up, and we talked about this, and I know everybody may not have been with us right when we started here today, but what we did, we go back over to the trade page. What we did on Snap is we came in and we bought the June 55 puts, and we did that Monday afternoon. Oh, there we go. So we bought them for $2.63. Those options are currently trading for around $3.90. So it's still a profitable position, but we ended up closing out the trade yesterday morning. We closed it out for $4.65. It gave us a $202 profit per contract. It was a 77% return on our capital. Okay, so what's interesting, if I go over to the chart pattern, I still like Snap to the downside. Okay, I mean, I still like the overall market to the downside. So why not hold? We still had over 40 days left expiration on that put position. If the chart pattern still is screaming to lean bearish, why not hold the trade? My explanation earlier was if I can book a 77% profit overnight in a market that has had very little follow through to the downside, I'm going to take advantage of that. Because any type of selling that we have had, now for the last 12 months, it lasts for a couple hours, couple days at a time, and then the market bounces right back to the upside. And I didn't want to give back all that profit. Now, could this be an example of an opportunity to scale out like we just talked about with David's question? Sure. I would not have a problem with that. Maybe you close out of 50, 75% of your position yesterday with a 77% return and kept a small position on, looking to see, do we get a runner to the downside? I would not have any issue there. I just did not do it personally. We ended up closing out of a full position yesterday, taking the profit. Now, I'd be more open to looking for the bigger winners on the downside if, I know it's a big if at this point, if price action starts to open up a bit for us, where we do start to see multiple days in a row on the downside, where it's not just 24 hours of selling and we bounce right back up and go to the highs. So if we can start to see that range open up a bit, like we talked about earlier, that would change how I could potentially manage some of these trades. So if you're not in a position on Snap, would I go ahead and initiate a position now? No. I think it's moved too far to the downside at this point. I think you're chasing at this point. If you initiate a trade now, I would wait for a potential bounce higher first. Okay. Try to get a bounce back up closer to that 58.75 level or so before initiating a new bearish position. That's how I would play it personally. But I already closed out of the position on my side here yesterday. All right. Any other questions on any other markets that you'd like me to take a look at? Go ahead and type those in now. Otherwise, I'm going to start to wrap it up here for the day, guys. Again, I will be back on Friday. We'll typically try to be in around 12 o'clock Eastern, so we'd love to have you join us. We'll take a look at what the market does between now and then. Take a look at some of these markets that we talked through today. We'll see what happens over the next couple of days. If you have any questions that you'd like me to help with over the next couple of days, feel free to email me. Mike@netpicks.com is my email address. Otherwise, enjoy your afternoon, everybody, and I'll talk to you hopefully on Friday. All right, we'll talk to you then.